It was Fed week again last week, and once again, all eyes were on Jerome Powell. And if you were watching, the Fed just cut rates by a quarter point, and every real estate investor is probably asking the same question: what does this mean for mortgage rates? If you've been waiting on the sidelines wondering whether this is finally your chance to buy, you need to know what really drives mortgage rates, because Powell's decision alone isn't the full story. By the end of this video, you'll know exactly what to watch, what's likely to happen next, and how to position yourself so you're not left behind. I'm Kenji Asakura. I'm a doctor, entrepreneur, and real estate investor who's used these exact strategies to shelter 100% of our federal income taxes for 7 years, and today I'm breaking it down for you. Here's the reality. Affordability is the biggest challenge in housing right now. Mortgage rates are stuck in the mid-6s. Home sales are at 30-year lows, and 7 out of 10 buyers are priced out. That's why the market feels frozen and why so many people are desperate for the Fed to unlock it. But here's the truth. The Fed doesn't set mortgage rates. So what actually does? And what could finally bring them down? That's what I'm going to break down in this video. Plus, what I think happens if they do fall and how you can position yourself to benefit. And stick with me to the end because I'll show you how falling rates, when combined with 100% bonus depreciation, could create a once-in-a-decade opportunity for high-income earners to build wealth and slash taxes at the same time. Every time the Fed meets, the news cycle goes crazy, wondering, will the Fed cut rates? But here's the part the media never really explains, and it's why so many investors get this wrong. They assume that when the Fed cuts rates, mortgage rates automatically drop. But that's not how it works. The Fed funds rate doesn't directly determine mortgage rates. Instead, mortgage rates are shaped by a handful of other factors. The 4 biggest are: number 1, inflation; number 2, the 10-year Treasury yield; number 3, Fed policy expectations; and number 4, economic growth. I'm going to walk you through each one of these one by one. First, inflation. This is the biggest driver. When inflation runs hot, say 4 to 5%, investors demand higher yields to offset it. That pushes mortgage rates up. And for rates to fall, inflation has to cool sustainably. Second, the 10-year Treasury yield. This is the benchmark mortgage rates follow most closely. If you chart mortgage rates against the 10-year, they almost move in lockstep. When investors pile into treasuries, yields go down. And when yields go down, mortgage rates follow. If you want to predict where mortgage rates are headed, don't just watch Powell's press conference, watch the bond market. Third, Fed policy expectations. Notice I said expectations, not the actual Fed funds rate. Markets are forward-looking. If investors believe the Fed will ease up on hikes and start cutting, bond yields drop. And when bond yields drop, mortgage rates come down. Fourth, economic growth and recession risk. If the economy is booming, rates rise. If growth slows or recession fears creep in, investors seek safety in bonds. That drives yields lower and pulls mortgage rates down. Those are the 4 drivers you want to watch. Now let's pause for a quick reality check. Today's 6 to 7% mortgage rates feel high, but that's only because we all got spoiled by rock bottom rates during the last decade. Millions of homeowners locked in 2 to 3% mortgages, so now anything above 5% feels painful. But historically, over the past 50 years, the average mortgage rate has been closer to 7 to 8%. And in the 80s, rates spiked into the high teens. When I first started investing in 2001, the average 30-year mortgage rate was around 7%. So no, rates today aren't historically high. But psychology matters. Breaking back into the 5s could be the real turning point for buyers and investors. And in a moment, I'll show you why that shift could open the floodgates of demand and what it means for your next move. So what's actually happened to real estate since rates climbed into the 6 to 7% range? Transaction volume slowed. Deals that used to cash flow don't pencil anymore. In multifamily, debt service coverage ratios have tightened, lenders are demanding more equity, and appraisals are coming in lower. That squeezed a lot of investors. But let's be clear, that doesn't mean there are no deals out there. In fact, for experienced investors, this market can be an advantage. Competition is down. The buyers who were overpaying in 2020 and 2021, they're gone. Sellers are more negotiable. And here's the real upside. If you have the right relationships and know how to spot good deals, this can actually be a better time to buy. In a moment, I'll show you exactly why lower rates, combined with the softer market, could create a rare window to scale faster than ever. But that's not the full story. While savvy investors are still finding opportunities, the broader market is still stuck. Most people are sitting on the sidelines, and fear is a big part of that. So the question is, what's it going to take to unlock the housing market? For homeowners, it's simple: affordability. Rates in the 6s and 7s have priced out millions. Most won't even think about moving until we break back into the mid-5s. But for investors, the calculation is different. It's not just about buying a home, it's about whether the numbers actually pencil out. At today's rates, many multifamily and investment property deals simply don't cash flow. But drop rates into the mid-5s and suddenly the math changes. Take a $500,000 fourplex. At 7%, the monthly mortgage is about $3,327. That's before you pay property taxes, insurance, or set aside for maintenance. In many markets, that level of debt service means you're breaking even or worse, running negative cash flow. Now drop the rate to 5.5%, the payment falls to about $2,839. That's nearly $500 a month back in your pocket, $6,000 a year. That shift alone can turn a deal from bleeding cash to putting money in your bank account every month. Now let's scale it up to a $5 million apartment building. At 7%, debt service is about $33,000. At 5.5%, it drops to $28,400. That's a swing of more than $4,500 every month, or over $50,000 a year. For a professional investor, that's the difference between a deal that doesn't meet lender requirements like debt service coverage ratio and one that qualifies for financing and cash flows on day one. This is why investors are watching rates so closely, because at 5.5%, the math starts to work again. Deals pencil, cash flow returns, and sellers finally have a reason to bring properties to the market. And in a moment, I'll show you how this turning point, combined with tax strategies like 100% bonus depreciation, could make this one of the biggest wealth building windows in years. And it's not just about monthly cash flow. Lower rates also expand your purchasing power. Let's look at a couple examples, starting with a smaller property. At 7%, a $3,327 monthly budget gets you about a $500,000 fourplex. Drop the rate to 5.5%, and that same budget qualifies you for roughly $586,000. That's 17% more property for the exact same monthly payment. Now let's scale that up. Take a $5 million property at 7%. With 75% leverage, that's a $3.75 million loan. At 7%, the monthly debt service is about $25,000. But drop the rate to 5.5%, and that same $25,000 now supports a loan of about $4.39 million, which means you could afford a property worth nearly $5.86 million. That's a $859,000 jump in purchasing power. Again, about 17% more property without spending a single dollar more each month. For high-income earners, that kind of leverage is huge. It can mean moving from a $5 million building into a nearly $6 million building. More units, more income potential, and even more tax advantages when you layer in strategies like 100% bonus depreciation. And in a moment, I'll show you why that combination, falling rates plus bonus depreciation, could create a once-in-a-decade opportunity for investors who are ready. And don't forget about current owners. If rates drop, millions of investors will refinance. And refinancing doesn't just lower payments, it resets the math across an entire portfolio. Think about it. If you're holding a $5 million property at 7% and refinance to 5.5%, you just freed up over $50,000 a year in cash flow. That's not just money saved, that's money you can redirect into your next deal. But it gets bigger. A lower payment improves your debt service coverage ratio, which makes it easier to qualify for financing on future properties. And if you pull equity during that refinance, that's fresh capital you can roll directly into another asset. So refinancing isn't just about saving money, it's about unlocking trapped equity, improving your borrowing power, and scaling faster. That's why rate drops don't just create new opportunities, they multiply them for investors who are already in the game. And in a moment, I'll show you how layering tax strategies on top of refinancing can accelerate this even further. And here's where it gets really exciting for high-income earners. Because it's not just rates, 100% bonus depreciation is back. That means you can pair strong cash flow from lower rates with massive tax savings in year one. If you missed my full breakdown, I'll link it here. But here's a short version. Bonus depreciation lets you write off a huge chunk of a property's value in the first year you own it, instead of spreading those deductions over decades. So imagine this, you buy a $500,000 fourplex at 5.5%. You're already $500 a month ahead compared to buying at 7%. Now add a cost segregation study and you create around $100,000 of bonus depreciation in year one. That could shelter 6 figures of income while your property is cash flowing better from day one. Now take it to scale. On a $5 million property, a lower rate could save you $50,000 a year in debt service. Add over $1 million of bonus depreciation, and suddenly you've improved cash flow and created a massive tax shield that puts real dollars back in your pocket. That's the double tailwind. Better cash flow, bigger tax shelters, faster portfolio growth. And it's especially powerful for high-income earners, because the higher your income, the more those tax shelters matter, and the faster you can recycle those savings into the next deal. Now let's talk about how to position yourself right now to take advantage of this tailwind, because when rates move, the window could be very short. So what does this all mean, and what should you be doing right now? If rates drop into the mid-5s, the market could heat up fast, and when that happens, competition will come flooding back in. But the best investors aren't waiting around. They're always building. They're sharpening their skills, running the numbers, and building their portfolios deal by deal. And they're building relationships with brokers, lenders, property managers, and other essential team members. Here's the thing, there's no better time to do that than right now. When the market is slow and agents are hungry, that's when they'll go the extra mile to bring you opportunities. So don't think of this as dead time. The work you put in today, finding deals, strengthening relationships, is what positions you to win when the market unlocks. And here's the bigger truth. Regardless of what happens with interest rates, there's no better tax shelter for high-income earners than real estate. With strategies like real estate professional status or the short-term rental tax loophole, you can dramatically reduce your taxes while building wealth. And that's exactly what we teach in our course, Zero to Freedom. If you want to learn step-by-step how to find deals, scale your portfolio, and shelter your income, just click the link below to book a free strategy call. Our team will show you the steps you can take to get started today. Because in this market, the winners aren't the ones who wait. They're the ones who keep buying, keep learning, and keep building. So when the market turns, they're already ahead. And if you're ready to be one of those winners, I'll see you inside. Thanks for watching. If this was helpful, hit the like, subscribe, and drop your biggest takeaway in the comments. I'll see you in the next video.